All right, listen up. If you're sitting there staring at a real estate listing, sweating over a mortgage rate, or wondering if that so-called dream home is about to become a nightmare, you've come to the right place. I'm Kevin O'Leary, Mr. Wonderful, and I'm not here to tell you fairy tales. I'm here to tell you how to make money, period. The housing market is the single biggest wealth generator or wealth destroyer for most families. And right now, it's a psychological battlefield. You've got friends telling you to wait for the crash. You've got realtors telling you to buy now or be priced out forever. You've got headlines screaming about bubbles, affordability crises, and interest rates. It's noise, all of it. So shut out the noise. For the next few minutes, I'm going to cut through the emotion and give you the cold, hard, analytical framework I use. This isn't about crystal balls. It's about capital allocation, risk assessment, and opportunity cost. By the end of this, you will have a clear, actionable strategy for 2025, 2026, and beyond. The question on everyone's mind, housing market in 2026, buy, sell, or wait. Let's get to work. First, a fundamental truth you must tattoo on your brain. Real estate is not a monolithic market. Saying the housing market is like saying the stock market. Is it tech stocks or utility stocks? Is it San Francisco or San Antonio? It's meaningless without specificity. We are in an era of unprecedented divergence. Winners and losers are being decided by zip code, by interest rate lock-in, and by local job markets. So throw out any one-size-fits-all advice right now. To make a decision, you need to analyze 3 pillars: the macro environment, your micro situation, and the alternative. We'll break down each one. Pillar 1, the macro environment. Where is the wind blowing? B-roll of Federal Reserve building, charts of interest rates, inflation graphs. The Fed is the 800-pound gorilla in the room. They've been fighting inflation with the blunt instrument of interest rates. As of now, we're in a higher for longer environment. The days of 3% mortgages are gone, likely for a generation. Get over it. The new normal is 5% to 7%. This is the single biggest factor suppressing transaction volume. Why? Because of the golden handcuff effect. Millions of homeowners are locked into sub 3% mortgages. To sell their perfectly good house and buy another one means doubling or tripling their interest expense. They are trapped. This is creating a historic inventory shortage. There are simply not enough houses for sale. Basic economics, constrained supply with steady demand supports prices. That's why we haven't seen a major nationwide price collapse despite rates shooting up. But demand isn't as steady as you think. Affordability is at a generational low. The monthly payment on a medium-priced house with 20% down at today's rates is a king's ransom. This is pricing out first-time buyers, the lifeblood of the market. So demand is fraying at the edges. For 2025 and 2026, the key macro questions are, do rates go down? The Fed might cut maybe 50, 75 basis points if inflation truly is tame. That's not a return to zero, it's a slight relief valve. Do we enter a recession? If the economy stumbles and unemployment rises, forced selling begins. That's when prices get real pressure. Do we get a supply shock? Will a flood of new construction finally hit? In some Sunbelt markets, yes. In the Northeast, no. My bet? A mild softening in rates, no deep recession, and a slow, painful grind in transaction volume. This is a market in stasis, not a market on the brink of a 2008-style collapse. The fundamentals are too different. Lending standards have been tight. There's no subprime bubble. This is a freeze, not a fire. Pillar 2, your micro situation. What game are you playing? This is where we get personal. Your move depends entirely on your profile. There are 3 archetypes. Archetype 1, the first-time buyer, you're renting, you're watching prices, you're terrified. Here's my rule. You don't buy a house to speculate. You buy a house to live in. If you are financially ready, meaning you have a stable job, a 20% down payment, yes, 20%, no excuses, PMI is money thrown in the toilet, and a budget where the PID, principal, interest, taxes, insurance, is no more than 35% of your take-home pay, then you can consider buying. But the question is where and what? In 2025, 2026, as a first-time buyer, you must be a ruthless value hunter. You're not buying your forever home, you're buying your first asset. Look for the ugliest house in the best neighborhood you can afford. Look for towns with infrastructure investment, job growth, and good schools, even if you don't have kids, because that's what preserves value. Forget about turnkey. Be prepared to put in sweat equity. Your strategy is time in the market, not timing the market. If you find a property that works as a home and meets the financial criteria and you plan to be there for at least 7 to 10 years, you pull the trigger, you ride out any volatility, you build equity. Waiting for a 10% price drop while rents climb 5% a year is a losing game. Rent is an expense. A mortgage, at least in part, is a forced savings plan. Archetype 2, the move-up buyer, the handcuffed one. You own a home with a sweet 3% rate. You need more space, you're stuck. This is a brutal math problem. You must run the numbers with icy detachment. Calculate your current monthly payment. Now calculate the payment on a $800,000 house, if you're selling a $500,000 one, at 7%. It will be horrifying. Your move depends on 2 things. How much equity do you have? If you have 50% plus equity, you can put a massive down payment on the new house, perhaps keeping the mortgage size similar to your old one. That might work. Can you turn your current home into an asset? Instead of selling, have you considered renting it out? That 3% mortgage is a weapon. If the rental market in your area can cover the mortgage and expenses, you now have a cash flowing asset. You use the equity via a HELOC or cash out refi for a down payment on your new primary residence. You become an accidental landlord. This is how you leverage the handcuffs to your advantage. If the math doesn't work for either of those, I have a very Mr. Wonderful piece of advice. Stay put, renovate, extend. Make the house you have work. The cost of moving up in this rate environment is a wealth tax you may not be able to afford. Archetype 3, the seller or would-be seller. You want to cash out. Maybe you're downsizing, relocating, or just taking profits. If you're in a high-cost, high-tax, low-growth market, your window to optimize may be closing. The out-migration from states like California, New York, and Illinois to Florida, Texas, and Tennessee is a real trend, but it's already priced in to some degree. If you're selling in a premium market, you still have strong demand from a smaller pool of wealthy buyers. Price it correctly from day one. The biggest mistake sellers make now is pricing for 2021. You'll sit and rot. If you're selling to rent and wait for a crash, you are playing a dangerous game. Transaction costs are enormous. 6% to agents, closing costs, moving costs. You need a 15 to 20% price drop just to break even, and then you're at the mercy of the rental market. This is a speculative trade, not a prudent financial move. I rarely endorse it. The one clear sell signal, you are over-concentrated. Your home equity is 80% of your net worth and you're nearing retirement. Diversification is paramount. Downsize, bank the tax-free gains, up to $500K for a couple, and put that capital to work in income-generating assets. Your house is not an ATM until you sell it. Pillar 3, the alternative. Opportunity cost. This is the most overlooked part of the equation. Every dollar you sink into a down payment and closing cost is $1 not invested elsewhere. Let's do simple math. Say you have a $150,000 down payment, you put it into a house, your total return is potential appreciation, let's say a conservative 3% annually, minus property taxes, insurance, maintenance, call it 2-3% annually, plus the imputed value of living there. It's complex. Alternatively, you could rent a similar property for, say, $3,000 a month. You take that $150,000 and invest it in a diversified portfolio of dividend-paying stocks, REITs, and bonds. A reasonable yield might be 4 or 5% with potential for appreciation. You must run this rent versus buy analysis brutally. Use online calculators, but be honest with the assumptions. In many markets right now with high prices and high rates, renting and investing, the difference is mathematically superior in the short to medium term. It gives you flexibility and liquidity. Buying a house ties up capital and ties you to a location. So what about 2026 specifically? 2026 will be a year of the great thaw. I believe we'll see enough rate relief, maybe rates in the high 5% range, that some of the golden handcuffs will loosen and inventory will slowly increase from historic lows. This will create more options for buyers, but also more competition from pent-up move-up buyers. Prices will not skyrocket. They will likely see modest nominal gains in most markets, maybe 1-3%. In overbuilt markets, they may stagnate. In chronically supply-constrained markets, think the Northeast, parts of the Midwest, they may hold firm. Therefore, your 2026 strategy should be forged in 2025. If you're a buyer, first time or move up, use 2025 to get battle ready. Save that 20% down payment, get your financial documents impeccable. Get pre-approved by a reputable lender. Become an expert on 3 to 5 target neighborhoods. Build a relationship with a top agent. When the right property hits the market in 2026, and you've done the math, you strike with precision. You are not emotional. You are an acquirer. If you're a seller, prepare your property now. Do the deferred maintenance. Stage it. Understand that you are no longer selling a lifestyle. You are selling a financial asset. Be ready to price it based on comps from the last 90 days, not from 2022. If you're selling to downsize and lock in gains, 2026 could be a good window as activity picks up. If you're an investor, because some of you are, the days of flipping with cheap debt are over. The game now is cash flow. Look for multifamily properties in markets with strong job and population growth. Look for strategies like house hacking, buying a multi-unit, living in one, renting the others. Your underwriting must assume 7% financing and conservative rent growth. No fairy tales. Ultimately, the decision to buy, sell, or wait is not about predicting the market's peak or trough. It's about aligning a major capital decision with your personal financial roadmap, your risk tolerance, and your life goals. Stop listening to the fear and the hype. Be an unemotional allocator of capital. If the numbers work for your life and your portfolio, you buy. If the numbers show you're overconcentrated or need to rebalance, you sell. If the numbers don't pencil out, you wait, rent, and invest your capital elsewhere. The housing market of 2025 and 2026 is not for the faint of heart. It's for the disciplined, the analytical, and the patient. It's a market for adults. Now you have the framework. Go run your numbers. I'm Kevin O'Leary. Go make some money.